When you read about the housing market in the news, you might see something about the recent decision made by the Federal Reserve, also known as the Fed. But how does this decision affect you and your plans to buy a home? Well, here's what you need to know. The Fed is trying very hard to reduce inflation, and even though there's been 12 straight months where inflation has cooled, it's the most recent data that shows it's still higher than the Fed's target of 2%. While you may have been hoping that the Fed would stop their hike since they're making progress on their goal of bringing down inflation, they don't want to stop too soon and risk inflation climbing back up as a result. Because of this, the Fed decided to increase the federal funds rate again last week. The Fed Chairman Jerome Powell said last week, and I quote, "We remain committed to bringing inflation back to the 2% goal and to keeping longer-term inflation expectations well anchored." To dive a little deeper, Greg McBride, who is the Senior VP and Chief Financial Analyst at Bankrate, he explained how high inflation and a strong economy plays into the Fed's recent decision. Inflation remains stubbornly high, the economy has been remarkably resilient, the labor market is still robust, but that may be contributing to the stubbornly high inflation. So Fed, well, they have to pump the brakes a bit more. And even though a federal funds rate hike by the Fed doesn't directly dictate what happens with the mortgage rate, it does have an impact. In a recent article from Fortune, they say this: the federal funds rate is an interest rate that the banks charge other banks when they lend one another money. And when inflation is running high, the Fed will increase the rates to increase the cost of borrowing money and slow down the economy. When it's too low, they will lower the rates to stimulate the economy and get things moving again. So at the end of the day, what does this all mean for you and how does it affect you? In the simplest sense, when inflation is high, mortgage rates are also going to be high. But if the Fed succeeds in bringing down the inflation, it could ultimately lead to lower mortgage rates, making it more affordable for you to buy a home. Check out this graph as it helps illustrate that point by showing that when inflation decreases, mortgage rates typically go down as well. As the data shows, inflation, now that's shown in the blue trend line, it's slowly coming down, and based on historical trends, mortgage rates shown in the green trend line are likely to follow. McBride says this about the future mortgage rates: with the backdrop of easing inflation pressures, we should see more consistent declines in mortgage rates as the year progresses, particularly if the economy and the labor market slow noticeably. At the end of the day, you have to live your life, buy your home, and of course focus on what you can control. So we see the bottom line as this: whatever happens to the mortgage rates, depending on inflation, if inflation cools down, mortgage rates will follow. And if you want a more in-depth conversation, we do invite you to reach out to us so we can walk you through all of the various scenarios specifically for you and help you reach your real estate goals on your timeline.